Here are the 10 most important tax changes from yesterday's budget explained in 60 seconds. Number 1, the second tier tax bracket from $18,200 to $45,000 will drop from 16% down to 15% from 1 July 2026, and then an additional 1% down to 14% from 1 July 2027. This equates to a tax cut of $268 per year. Number 2, there's a $1,000 instant tax deduction available without receipts. However, this will only be claimable after 30 June 2027, which is more than 1 year away. And what this is an uplift from the previous $300 tax deduction. Number 3 is what's called the Working Australian Tax Offset, or WATO for short. And this provides a $250 offset for salaried employees. This is intended to be permanent, however, will only start for the year ending 30 June 2028, which is more than 2 years away. Note, however, that this is non-refundable. Therefore, if you are not going to pay any tax, you won't receive this offset. Number 4, the $20,000 instant asset write-off is now permanent, which means that if small businesses purchase an asset costing less than $20,000, they can claim a deduction in the year that they purchased the asset. There will be a reintroduction of the loss carryback provisions, which means if a company is making a loss, it can then look back 2 years to see if they made a profit and then claim that back as a refund in the year they made the loss. Number 6, startup businesses can claw back any losses they make in the first 2 years of operations. However, this is capped to the amount that they pay in PAYG withholding for their employees. Electric cars costing up to $75,000 will continue to receive the FBE exemption. However, this is only up until 1 April 2029. And then after this date, they'll only be eligible for a 25% reduction in FBT. Okay, now the spicy stuff. Number 8 is that the 50% CGT discount is now replaced with an inflation-based method. Note, however, that this kicks in 1 July 2027, and there will be a minimum payable of 30% on gains regardless of what this calculation comes to. Note also that investors in new builds will be able to still use this 50% CGT discount. However, they can choose between using this old method and utilizing this new inflation-based method. Number 9, negative gearing will now be limited to new builds only. Note, however, that properties which were owned prior to budget night will still be eligible for negative gearing. And number 10, and probably worst of all, is that there's now a 30% tax on discretionary trusts. This kicks in only 1 July 2028, which will allow enough time for pre-existing structures to obtain a rollover relief into new structures. So that's it, guys. That's all 10. Let me know in the comments what you think of this. Is it a good result or is it a bad result? I've got my opinion. I'm fairly sure most people agree with what I think. Check out my other videos where I go into depth about what the outcomes of this actually mean. Like this video, share it, subscribe, do your thing. See you later.